What is up, Ichimoku traders? Chris Capri here, SecondSkiesForex.com. So, this is the first of the major strategies that we're doing for the V2 of the Ichimoku course. This strategy, which is called the Wave 1 setup, and we will just call it, in future, in terms of like future referencing, we'll just say, hey, Wave 1 setup, Aussie dollar, or something like that. So, this is going to be a bread and butter wave setup that we're going to be doing. And what we're really doing is taking a combination of wave structure mechanics, particularly in N wave, with supportive conditions that would allow us to kind of take advantage of that particular N wave and this particular type of setup so that we can hit our D point calculation. So what I'm going to do is I'm going to get into the entry conditions for this, and I will explain that in terms of what that means in terms of a wave structure, in terms of 5-line structure, what kind of key variables we're looking for. And then I'm going to go into some examples, and then what we're going to do is I'm going to explain the stop loss and take profit conditions for those particular, for the Wave 1 setup based upon the prior conditions. And I will again show some examples of it. So I'll go over these particular examples that I have in the Aussie dollar and Euro dollar, show the entry conditions, just so you get the entry down and the basic mechanics of the entry down and why we're doing this. Then once we kind of have that in place, then we'll start to explain how you choose your stop loss and take profit. And so that's pretty much it. So let's go ahead and get into this. So the Wave 1 setup is a with trend wave setup, and what we are looking for is a particular N wave with trend, and we're going to be trading the break of the B point. And so for those of you that kind of need a brief refresher, so these are basic N waves. There are 4 major types, however 3 are really common. One of them is uncommon. So the V type wave calculation or N wave structure, the N calculation N wave structure, the E calculation N wave structure, and then the NT, which is very uncommon. We won't really talk about that in this particular video. So we're just going to be talking about the N, the V, and the E N wave structures based upon price calculations. Now, the underlying premise, just to kind of give you the framework and kind of theory and mechanism behind this, is what we're really trying to do is take advantage of an N wave structure and get into the market at the break of this particular B point. Now, depending upon the type of wave, whether it's an N price calc, V calc, or E calc, kind of has an effect upon both the type of profit target and stop loss that we're going to be taking and the nature of that particular wave. If you look at a V calculation, it's the deepest wave of all of them. N is a very shallow one. E is shallow, a little less shallow, or a little more shallow. No, less shallow, sorry. But it's still a pretty shallow wave. I mean, you're talking, not even a third of the entire wave is retraced. So we have a sharp I wave, then we have a little bit of a pullback, and then we have another sharp I wave up. And N calc is a very strong I thrust, a very sideways corrective structure here on this pullback, and then another move up. The V calculation is, for a particular pair price action that's swinging kind of big, you can see that the pullback is definitely past the midway point. It's not all the way, but it's definitely between the midway and the final point, or the 0 point here, A point here. And so each wave has a certain relationship to the A point, the depth of the pullback, and therefore how much profit potential is, especially if we are trading on a break of the B point. And we're not just trading any particular N wave and like, oh, it's broken the B point, that's it. No, we're setting up underlying conditions that will make this more favorable and more probable. And so we're really trying to take advantage of, once we clear this here, we're trying to take advantage of this move particular here. So once we get above B, we're trying to take advantage of that. So that's kind of the underlying theory, and I want to kind of get into some of the mechanics behind the entry conditions. So let's get into that. So the entry conditions for a wave 1 setup is we're looking for an N wave with trend, and we're looking for the break of the B point. Now, what does that mean, N wave with trend? And so I wanted to kind of define that and codify that a little bit further. From a with trend from a 5 lines context means that the price line is clearly on one side of the Kumo. That means it's not inside the Kumo, but it's above or below the Kumo. And then on top of it, we have to add in the condition that there has been a TKX in the same direction as the price line above or below the Kumo. So if we have the price actions above the Kumo and we have kind of like an N wave forming, well, the price line has to be above the Kumo, and there has to have been some sort of TKX. It can be a weak, a medium, or strong in the same direction as we are in relationship to the Kumo. So if we're above the Kumo, there has to be an upward TKX, and if we're below the Kumo, there has to be a downward TKX. Doesn't matter whether it's weak, medium, or strong. They're just those two things from a 5-line context have to be in place. With trend from a wave structure means that the B point is broken on the current N wave that we are in. So it doesn't matter what kind of, whether we're in a V calc, an N calc, or an E calc. The bottom line is that we are in an N wave structure and we've broken this kind of B point here. That's the first thing. The second thing, and this will make more sense once I show you some charts, is that the prior C point of the prior wave has to have been broken. And what do I mean by that? So let's say we have a bullish N wave, and that is that has taken out the C wave that was going in the opposite direction. So in other words, from a with trend wave perspective, if the current N wave is going counter trend to the prior wave structure, it has to, at a minimum, have broken that prior C point. And as you know, breaking that prior C point on the other side or other trend wave structure is crucial to kind of disrupt the wave structure. So we're qualifying with trend in terms of wave structure as B point being broken, plus another way to say this would be disruption of the prior wave structure, and that would be the C point. So we know that when a C point gets violated, that wave structure, N wave structure, has been violated to some degree. So we're trying to align these underlying conditions to make this a much more probable or favorable trade. I know that may sound like a lot theoretically, so I'm just going to show you some charts right now so that you can kind of get into this and what it looks like. Okay, so you should be seeing the Aussie dollar on a 1 hour time frame, and I'll explain time frames later. I'm just kind of doing this to show you the general mechanics. But let's take an let's take an N wave structure we have. So we have an A, B, C, D. I've marked it A here. Here's the B point. Here's the C point. And what we had was he had a prior kind of stabilization of up waves. I can show you real quick. And we have broken through the C point on this wave by breaking below it here and here as well. So you broke through this kind of C point. So that qualifies from a wave structure standpoint. We have a with trend wave with a, oh, my colors are off. I just noticed that. Okay. So those are fixed now. So what we have is a TK on. We have the price line below the Kumo, so it's clearly on one side of it. We have a TKX in the direction of that, so 5-line context is supportive. And we have a disrupted wave structure. So all of this has the marking for a wave 1 setup. And so how does this work? Well, we have the wave 1 setup. We have the qualifiers in place. Here's your A, here's your B, here's your C. Once we break this B point, and you're probably going to ask, by how many pips and how much do we need to close on it? And my overall answer is no, we don't need to close on the other side. We're assuming that with the right context, with the right 5 lines, with the right structure, that we're more likely going to break this B point. And so we're going to take that on a break. And my general rule is you want to be about 5 to 10 pips break of that on any time frame from the 1 hour up. You want to have about a 5-10 pips break below the low of the B point on that wave, and then you're able to get in. So you don't have to wait for close. You're just going to get into the market on that break. And we're kind of doing this because we assume that a breaking of this particular B point will add a fresh round of momentum and order flow in our favor. Now, if you look at what kind of N wave we have here based upon the ABC, this should be pretty straightforward as an N calc. So it has a very shallow corrective structure to it. It's a very strong impulsive I wave. shallow corrective structure, almost sideways. This could be interpreted as a sideways move. And so what we do is we have an N-calc N-wave type structure. And so now that we have that, we know what type of D target we're looking for because we know the price calculation based on this. So getting back to the chart, what we're doing is we're trading a break of this. We have a favorable context from 5 lines and wave structure. We're taking a break of the B point. We know what type of price calculation we're in. And so with the ABC wave, which is an N price calc, I've done the numbers for you. 78.13 is your A point. Your B point's at 76.54. Your pullback, very shallow, not even 30 pips, 76.82. So definitely an N wave type calculation. Therefore, our D point is going to be 75.23. So here's our entry point, basically. It's going to be just below the low of this here. We're getting in. Don't pay attention to the candle. I'm not getting on the close of this candle or the open of this one. I'm just getting in, basically. So as soon as we get the break, that's kind of our entry. And eventually we hit it. I think the target 75.23 was touched right about here. Don't worry about stop loss and take profit. I just want you to get the basics of the wave 1 setup entry conditions at this point. And to kind of make it easier for you, Aussie dollar gave a nice wave 1 setup of an E calculation shortly after. So this one right here, which is an A, B, C, and then a break of this. So if you look at this kind of pullback, this could be an N calculation. I'm leaning towards an E calculation. That could be debatable, but I'm really just kind of showing you an E calculation just so you kind of have an idea of what it looks like. So if you remember from your E calculation price theory, A is 76.83, B is 75.70, C point, the pullback is 76.19. So a 49 pip pullback. So definitely bigger pullback than this one here. So a little bit bigger pullback, a little bit less strong of an I wave down from A to B. So I'm leaning towards this being an E calculation. Therefore, my target is going to be 74.57, and that ends up getting hit right about here a little bit late, about a week and a half later. So that's your basic E calculation. I'm going to show you a V calculation after I talk about stop loss and take profit. It'll make sense later, but you should understand the basic mechanics of this. We're taking advantage of wave structure in favorable 5-line context. And when this certain cocktail comes together, we want to be taking advantage of a break on the B point. And so that's pretty much how all this works out. In terms of stop loss and take profit conditions, these are relatively straightforward. And they're pretty easy to codify. So the stop loss is going to be price calculation dependent. So we have to determine what kind of wave structure we're in, and we can't make that final determination until we break the B point. Until we break a B point in the N wave, all we have is a V wave. We have a theoretical N wave, or an orphaned N wave, or an orphaned I wave or V wave until we break that C point. So basically, in any wave structure, there is no potential N wave in place until the B is broken. That's the only way you can have the potential for an N wave to manifest. So we won't know exactly which one we have until we have the break, but we can kind of know ahead of time. If you see the market has pulled back and then is now attacking that B point, you should be able to make a pretty good judgment whether you are in a V, an N, or an E calculation at that point. And so once you get that break, then you can make the official calculation. Then you can determine your take profit. But your stop loss is also going to be based upon the type of price calculation and wave structure you have. Now, your golden, and this is going to be a general rule. It's not going to be kind of like, okay, it's exactly 45 pips and this and that. That doesn't work. It just doesn't work. The market volatilities, currency pairs change. All these things are different. There's no fixed quantitative way to look at this. These are relative guidelines that you're going to always use, and it gives you a framework for deciding your stop loss and take profit. And once you kind of understand the framework, it'll make sense. You won't have to be worried about, it should be 22 pips or 23 pips or this and that. No, we're using 5 lines and we're using the wave context to help us build a stop loss, a relative high probability stop loss that won't get triggered. That's what we're trying to build. For an N calculation with a stop loss, and this will make more sense once I actually show you the wave structure or the price structure charts and the actual charts that I have themselves. But your stop loss on an N wave is going to be between the Kijun and the Kumo. Now, if we think about, here's your N wave. So it's a pretty shallow pullback. The more shallow the pullback, and assuming we're above the Kumo on this move, the more shallow the pullback, the less deep you need to go into the 5-line context to determine your stop loss. So this type of move by default is assuming a high momentum with trend move that probably hasn't violated the Kijun too much. Therefore, our stop loss is going to be between the Kijun and the very beginnings of the Kumo. We leave a little bit of room in the Kumo because sometimes the market can kind of go to the Kumo a few pips into it before the Kumo actually acts as support or resistance. So our relative stop loss is going to be between the Kijun and the early portion of the Kumo. That right now might not make sense to you. It will once we start to look at charts. For an E calculation price move, the stop loss is going to be inside the Kumo, and that's going to either be in the early portion of it or the later portion of the very end of the Kumo. And we'll kind of talk about some relative guidelines you can choose for that. You're going to have to use some discretion here. There's no perfect answer for this. There's no quantitative answer that is going to always give you the exact stop loss. You just have to use it as a relative framework and guideline for determining it. And so your stop loss in this case is going to be inside the Kumo. And we'll talk about some various conditions and examples to give you an idea of what that looks like. A V calculation, which is your biggest, it's your biggest pullback of all the wave structures. So a V calculation stop loss is if the if NV stands for if not violated. So if we are in a move, let's say we're in a bull trend, it's A, B, C, and the V calculation hasn't broken below the Kumo, not violated the other side of the Kumo. So if we're above it, it hasn't violated the bottom of the Kumo. And if we're below the Kumo, it hasn't violated the top side of the Kumo. So if we haven't violated the other side of the Kumo, that's going to be one type of stop loss. So if we haven't violated, then our stop loss is on the other side of the Kumo. Very straightforward. If we have violated the Kumo, then what we're looking for, and I'll show you an example of this, a really good example of this with the Euro-dollar recently. If we have violated the Kumo, then our stop loss is going to be placed based upon the most recent TKX with trend. So if we're looking for a bullish move and a bullish break above the B point, the most recent TKX, that's where our stop loss is going to be. I know this may sound theoretical or may sound kind of hard at this point or conceptual. When I show you some charts, it'll start to make sense. Try to hold your questions till then. The take profit is very straightforward. It's the D point price calculation based upon the type of wave that we have. So let's get into some wave one stop loss and take profit examples based upon the charts that we're looking at. Okay, so this is the most shallow wave structure that we talked about this before. This is an N wave. And so the stop loss for your N wave, wave one setup is going to be between the Kijun and the Kumo. If we haven't violated the Kijun, we can put it, my general recommendation is to put it anywhere between 1/3 of the way to the Kumo, all the way into the Kumo, maybe a little bit on this side of the Kumo, and that's it. Give it a little bit of room. If we have violated the Kijun by some chance, then you want to gain distance from it and push and encroach a little bit more into the Kumo as much as possible. But this is going to be your relative stop loss placement. So to give you an idea, it will look like here's where your stop loss is going to be placed. And if you think about it, for a shallow N wave structure, if that structure and that shallow corrective pullback is playing out, you shouldn't need too deep a stop loss. So, this is kind of where we want to be with that. The great thing about shallow N waves is that once the B point is broken, we have a pretty shallow stop loss. In this case, our entry is below 76.54. So let's say it's 76.49. Well, our stop loss is anywhere from, say, 40 to 51 pips higher. And yet we have a target, which is 125 pips later. So just by the nature of the wave structure, this offers the highest plus R potential on it here, and the shallowest wave or shallowest stop loss on that. For the next type of wave, which is this one here, this is an E-calc, so it's got a slightly bigger pullback. Well then, because we've crossed the Kijun, therefore we have to encroach a little bit further back. So now we're kind of moving into kind of this territory right here. This is kind of the general region of where you're placing your stop loss. Now there's no fixed answer that should you be, in this case below the Kumo or inside Kumo, because there's going to be so many different price line, Tenkan, Kijun, Chikou, Kumo configurations. The best thing you can do is say, okay, what is the place where the market should not go from an Ichimoku 5-line context? Where should the market not go if this kind of wave 1 setup idea is correct? And while it could possibly make its way into the Kumo, the bottom line is we're getting in on the break of this here. So here's the break right here. So then we got to shift this whole thing over. Let me put a horizontal line where entry is. You'll get an idea of what I'm saying. So here's our entry right over here. In this case, now we move the stop loss to about here. So we give it a little bit more room to work with. Since it's shown a greater tendency to violate the Kijun, we give it a little more breathing room and we go a little bit deeper into the Kijun. Obviously, since this is a deeper pullback, therefore we have to have a deeper stop loss, and therefore there is slightly less profit potential in this one. But it's still a great setup. It's something you have to take. The decalc on this one here was 74.57, and it ended up hitting that right over here not too long after, about a week and a half after. So these are your N calcs and E calcs in terms of the stop loss. The take profit's easy. It's where your decalculation is. So don't have to really spend a whole lot of time in that. But what I do want to do is show you the same kind of stop loss placement on the V calculation. And we had a great example in the euro dollar. Okay, so in the euro dollar here, we started bottoming and then we started breaking the C point here. This broke at A, B. This broke this prior C point. So we have an A, B, C, D. This is kind of like an E wave, or it's not quite an N wave. It's kind of more of an E wave pullback. So A, B, C, D. When we look at this little box right here, we have an A, B, C, very deep pullback. It's almost half or a little more than half of this entire move. So that qualifies as a V calculation or a V type N wave. We're getting on a break here, so about 2093. When you do the math and you do the V calc, here's your A, here's your B, here's your C. So that comes out at 2253, which is this little thrust up here. That's roughly where your profit target is. So we can see with the V calc, by taking the break of the B, we have the least amount of profit potential in this one here. And so therefore we kind of have to adjust our stop in such a way we can't trade, put our stop loss below the bottom of this V calculation, because if you think of a V calculation by default, it's the deepest pullback. It goes anywhere from 50% all the way down to almost a full retracement of the entire move. So if we put it below the C point here, well, just for shits and giggles, your stop's at 1910. That's a 180 pip stop, and your total profit target is about 160 pips. That's an inverted R to R. It doesn't make any sense. Our general target range that we're going for is no less than 1.25 to 2R on this. You'll probably average between like 1.5, 1 3/4, sometimes, a little over plus 2R, maybe sometimes plus 3R, depending if it's an N wave or not. But the bottom line is that you don't want to be taking any setups to where your profit potential in this one is less than 1 to 1. We're looking for about 1 1/4 at a minimum. So if we can't take this particular place as our stop loss, well, then what other options do we have? Well, we have an option here in this case. So in this case, the V calculation broke below the Kumo. We had a TKX, and then it broke back above the Kumo and then broke the B point. So this is a with trend move. We have a prior with trend cross. We've broken this, the B point here. We're getting in on the break at about 2093. So in this case, since we have violated the Kumo, if violated the Kumo, then our stop loss is where the TKX is. So the TKX happens here. A few days later, it breaks it, or a few candles later, it breaks it. So here's where our stop loss is. So we have about 100 pip stop, and now we have about 160 pip target. So a much more favorable R to R. If this pullback was, say, way above the Kumo, then it pulled back into the Kumo, but it didn't violate it, then our stop loss in this case would be on the other side of the Kumo. But in this case, we're using a TKX, the most recent TKX, as our stop loss placement. So that is the basic mechanics of the Wave 1 setup. This is going to be a bread and butter. Obviously, the more supportive conditions there are, the more with trend you're trading. For example, a trend that's been in place for a little bit now, it's had several waves in its favor, it's been above the Kumo for a while. That's obviously going to add to the probabilities of it. Also, if you have higher time frame context, that's also going to add to the probabilities of it. Want to trade as much supportive conditions as possible, but as long as you have these minimal conditions in place, this is a valid setup then for a Wave 1 setup. So we're really taking advantage of wave structure and 5-line context, and we're trading the break of that B point with some very specific underlying supportive conditions. And by combining that with the price calculations, we know what types of waves we have, we know what types of stop loss and take profit we have, and we know where to place those. So that's pretty much it. This is a lot of information for your first time kind of digesting this. And so my recommendation is this. More than likely, you didn't take in all this information the first time around. So I would suggest watching this video again and kind of checking through your notes and making sure you kind of got all the key points. And then instead of asking 100 million questions, which you're going to have, because it's the first time you're kind of learning this, and there's a lot of kind of nuances and details, just get the basic mechanics down. So you need the basic entry mechanics, and those are based upon very clear 5-line and wave structure conditions. And then you need your stop loss condition, and your take profit is pretty straightforward. It's your decalculation. So what I would recommend is first practicing, instead of asking a million questions. What about this? What about this? What about this? What if it looks like this? What if it looks like this? Fuck, man. There's a million conditions on that. Instead of kind of just bombarding everything with all these conceptual questions, first practice the skill. So what's that going to look like for you? The first thing you're going to do is, once you have the basic mechanics down, you're going to look at charts and just try and see if you can spot the entry conditions for the Wave 1 setup. And you can throw a bunch of charts on, into the course and say, hey, practice Wave 1 setup. Here's some examples. Did I get it right? And then I can tell you yes, no, yes, no, yes, no, whatever. Once you have the basic, or you're able to consistently spot the entry conditions for a Wave 1 setup, then you're going to start practicing with the same setups. Okay, based upon the ones that you said were correct, here is where I place my stop loss. Here's my decision on this. Here's my price calculation. Here's the wave analysis on this. Here's where I'm placing my stop loss and why. And then I will give you feedback again. And as you start to do this, instead of it being like ask a million questions based on concepts and information, you're actually practicing the skill, embedding it in. Some of those questions are going to go away. And the ones that aren't, that's where I come in. So do me a favor, once you're done with this video, watch it again. Go over the basic components till you feel like you have the guts down. And then you're going to practice just entry conditions. And then after that, you'll take those same trades and practice your stop loss placement on that. And then through time and practice and refinement, you'll have this setup down, and it will be a great bread and butter setup. So that's pretty much it. Practice first, ask a shit ton of questions later, because most likely through your practice, you'll answer a lot of those questions. You save me time, you save you time, we save everybody time. And it's just a much more effective way to learn, because it means you're shifting from conceptual knowledge to actual practice and execution knowledge, which is different. So with that being said, this is the Wave 1 setup video. I look forward to your comments and questions. I hope you enjoyed this. I look forward to you guys posting a lot of setups on this. One last thing I forgot to mention, which is time frames. You can use this on any 4 of the time frames that we use in the course: 1 hour, 4 hour, daily, and weekly. Just make sure the entry conditions are satisfied on that particular time frame. If that's the time frame you're trading, then the entry conditions and everything else has to be available on that time frame. Not another time frame, but that time frame. So I hope this helps. I look forward to your comments and questions and your charts and your practice on this, and I will see you inside the course.